Hello, everyone. I'm Sharon Fenolio, Associate Vice Chancellor for Advancement, and I would like to welcome you and thank you for joining this Legacy Council Lecture Series presentation, Building Your Financial Future. We're thrilled to bring this presentation to such a large and wonderful group, but before we get started, I'm going to go over a few housekeeping items. First, if you need technical support, we will have someone to stand on standby to help. The best way to reach us is through email. If you need help, please email executiveevents@umsl.edu. Again, that's executiveevents@umsl.edu. Second, we'll be using the Q&A feature on Zoom to ask questions throughout the presentation. This is located in the toolbar at the bottom of your screen. Questions will be monitored and addressed at the end of the presentation. We'll answer as many questions as possible. The presentation is being recorded. A link will be sent in a follow-up email to all registrants. So there's been plenty of excitement these last few days as students, faculty, and staff return to campus for the start of the fall semester. These photos capture what things looked like on Monday. Social distancing, masks, instructor face shields, and new signage are just a few of the new practices in place to stay smart and stay safe at UMSL. With 60% of the classes are virtual, there are labs and other classes of 29 people or less that require in-person instruction. But at UMSL, student success continues to be our greatest commitment. And during this pandemic and resulting dramatic economic upheaval, we look to support our students even more. We know this, when financial barriers for UMSL students are lifted, they can enroll and stay enrolled in school through graduation. Scholarships fill the gap of unmet need to transform the lives of UMSL students working to build better lives through education. I encourage you to think about including UMSL in your charitable giving as you plan for your financial future. Now, without further ado, it's my pleasure to introduce our first speaker, Peter Racen. Peter is a business owner, entrepreneur, and estate and business planning specialist with Racen Wealth Management of Northwestern Mutual Wealth Management Company. Peter spent the first 21 years of his professional career working in a family-owned business that was started by his grandfather in 1946. The company grew over the years, but also dealt with several issues, including the unexpected death of Peter's father at a very young age. The family business sold successfully to an outside buyer in 1999, and Peter joined Northwestern Mutual in October of 1999. Peter and his team provide comprehensive financial planning and wealth management to individuals and businesses. Peter is a 1980 graduate of the College of Business, and while at UMSL, he was a swimmer on our swim team. So, Peter, I'm going to turn it over to you.
Thank you, Sharon. Good evening, everyone. As Sharon mentioned, my name is Peter Racen, and I'm the Director of Estate and Business Planning with Northwestern Mutual here in the St. Louis area. So thank you for joining us today to learn more about creating financial security. Since financial security can mean very different things to different people, let me first start by asking you to think about, what does financial security mean to you? Many people feel like they've reached that goal of financial security. Others don't. If you are one of the ones that say, no, you don't feel like you've reached that, know that you're not alone if you feel that way. In fact, 7 out of 10 Americans agree with you. That's how many people say their financial plan could use some improvement. And most of them aren't sure how to go about changing that either. Only 22% are very confident that they understand how to build financial security. And only 32% have a financial advisor. So you already have a leg up on those other people out there because you're here tonight. You're taking the first step by learning more about financial planning. And that's a great first start. The first thing to realize about financial planning is it's not a one-size-fits-all. It's just like I said, that everyone has a different idea about what financial security is. Everyone also has a different starting point. Where you are right now as you're working towards financial security is different from the person sitting next to you. You also have different goals, your dreams for the future. Maybe someday you want to start your own business or go back to school. Maybe you want to have a big family or retire to a vacation home in the mountains or travel the world. You're unique. Your circumstances are unique. And for your financial plan to be put you on the right track towards achieving your goals, it should also be unique as well. The second thing to realize about financial planning is that it's not a one-time event. The only thing you can count on in life is that it's going to change. So your priorities evolve, your finances do too, and your financial plan needs to keep up with you. Some of the areas that can cause change in your life that may require you to update your financial plan are things like getting married or moving in with someone, having kids moving out or back in, deciding to buy a home or vacation home, going back to school, starting a business, caring for aging parents, inheriting money. So many, many different things throughout our lifetime can trigger a change in our circumstances that may require us to update our financial plan. So it's important to have it is important to have a financial plan. It's also important to keep it updated. And how do you create a plan? So there are three main strategies that we'd like to have you think about tonight. The first one is you need to protect against the unexpected by managing risk in your plan. The second is saving and investing to help you reach the goals you have for the future. And then the third is preserving what you've already worked so hard to achieve. All three of those are very important. So let's take a look at each of them individually. So the first strategy is risk management. So that first step is in creating your financial plan. And let me just delve into that a little bit more and tell you what I mean by that. So risk management is protecting your ability to reach your goals from things that are beyond your control. There are things that no one wants to think about, frankly. Things like getting sick or injured or dying too soon. It's not fun to talk about, but managing risk is one of the most important aspects of financial planning. In fact, tonight, I have more slides that I'm able to go through tonight on some of these topics. So you might see me skipping through some of this information fairly quickly, but you will have access to this information after the event is over. So you can go back and refer to it. An important first step in managing risk is to set up an emergency fund. If you don't have one, start one as soon as possible. Life is unpredictable and you need a short-term safety net because no matter how careful you are with planning your finances, things do come up unexpectedly. Just to give you an idea of a general rule of thumb, you should consider keeping an equivalent of 6 months of living expenses in an account you can easily access. By having a cushion when you need it, there's less chance you'll end up having to pay for emergencies by using high-interest credit cards or by dipping into your retirement savings. Next, start on planning on paying down debt. It could be a variety of different types of debt. Most people have some type of debt in their monthly budget, like student loans, mortgages, car payments, credit cards. It's a very common thing. But when we have debt, we open ourselves up to risk. If you're interested in learning more about paying off debt, please contact us, and we have some information we can share with you that goes into more detail on different types of strategies that you can use to reduce your debt. What do you think is your most valuable asset? People often answer that their home or their car or investments are their most valuable asset. But when you think about it, you wouldn't have any of those things without income. Your ability to earn an income is your most valuable asset. Let's face it, the life you're creating for yourself is based on the money you're making now and what you expect to earn in the future. If you lose that earning power, what happens to your lifestyle? And what does that mean for your goals for the future? You need to be able to protect your ability to generate that income. So what does that mean? There are three basic threats to our long-term ability to earn income. There's disability, a long-term care event, and death. Most people think something catastrophic needs to happen in order to take advantage of disability income insurance. But the reality is most disabilities are caused by heart attack, strokes, cancer, back problems, or pregnancy complications. These are actually fairly common occurrences. Some of you might have group disability insurance through your employer, and that's great, but most group plans have some sort of cap, usually about 60% of your income, which means you take about a 40% pay cut if you're on a disability plan. So most individuals need to supplement their group plan if they have it through their employer with some type of individual plan. And the other thing to keep in mind with group disability type plans is they're normally taxable benefits. So after you pay taxes on the benefits you receive, you're actually replacing a much smaller percentage of your income than you might be thinking. There are other considerations for risk management too. You might think about how many of you are providing care to a loved one now or at some point in the past. Usually I find when I'm talking with clients about this topic, the individuals have actually had real life experiences, either with a loved one or a family friend or someone close to them that needed some type of long-term care services. They're the ones that really understand the importance of this type of planning. Long-term care services help people with chronic illnesses, disabling conditions, or cognitive impairments that they get through daily routines. Care is often provided in the patient's home, but could also happen in like an assisted living facility, an adult daycare, or nursing home. And you might be surprised to learn that long-term care is not generally covered by Medicaid, and it's not covered at all by Medicare or health insurance plans. I find in working with clients, there's a lot of misconceptions about what Medicaid and Medicare or health insurance plans pay for. In this case, they do not cover the cost of what's referred to as the activities of daily living, such as bathing, dressing, eating, and those types of things. So if you need assistance with those activities of daily living, that's where long-term care insurance plays a role in helping cover the costs of that type of care. If you or someone you love needs long-term care, the financial and emotional and physical impact could be devastating. So it's something that you should consider and think about as you develop your financial plan. And there's a final threat, or a third threat to your ability to earn income, and that's death. Death is inevitable, and most people buy life insurance to protect the finances of the people they love. But how much life insurance do you need? I can tell you over the years as I've worked with clients, many times no one's ever helped them determine what's the right amount or what's the right adequate amount of insurance that they need to protect if they were to die unexpectedly. And the answer really is personal. It really depends on your circumstances and your goals. So we would help you, or financial planners should help you address those issues to determine what's the adequate amount to cover all the things that you want to accomplish and have the hopes and dreams that you have for your family. So we've talked about the three different risks: disability, long-term care, and death. Three unpredictable circumstances you can protect yourself against. The second strategy is wealth accumulation. So along with risk management in creating a lifetime of financial security also involves growing your wealth. And that means saving and investing for future goals. Accumulating wealth means different things to different people. But here the goal is to make the most of your money by making investment decisions that are right for you, decisions that help you achieve your goals. Choosing how to invest your money has a huge impact on whether or not you achieve your goals, particularly long-term goals like saving for college or retirement. Speaking of college savings, since one of the most common longer-term goals for children or grandchildren is college savings, let's talk about the cost of college. In a recent statistic from the College Board, tuition fees and room and board currently average $21,370 per year for a one-year cost at a public four-year in-state school. A private nonprofit school would cost significantly more than that. And these costs, by the way, are expected to only increase. In fact, they're increasing typically at a faster rate of inflation. We normally recommend anticipating about a 6 to 7% increase each year. There are ways to save for your children's or grandchildren's education through programs like Coverdale education accounts, 529 plans, or other options as well. The key to saving for college, though, is to start as early as possible. Probably the most common long-term goal, though, is retirement savings. So no matter what stage of life you're currently in, one thing is certain: funding retirement is far different today than it was in previous generations. Today, you're responsible for funding your own retirement. The era of pension plans are pretty much long and gone. It's really up to you to take advantage of 401ks, contribute to IRAs, and make other long-term investments to help you get through retirement that could last as long as 30 years or longer. And while we've talked about college savings first, I always recommend that you work on your own retirement savings before you start on college funds. The reason is because your kids have other ways to pay for school, like loans, scholarships, grants, etc. But if you run out of money in retirement, you could have to work longer and change what your retirement looks like, or even rely on your kids to help you out. So keep that in mind too as you're doing your planning. No matter what your long-term goals are for saving, the challenge is investing your money in a way that gives you the best chance of achieving them. So how do you accomplish that? Well, you first start by asking yourself a few very specific questions. The first question is, how much risk are you willing to take with your money? And do you have the stomach to watch your balances go up and down as the markets fluctuate? If the chance of reward is greater, are you willing to risk more? Or would you prefer lower risk and potentially lower reward? This is called risk tolerance. And then how long will you plan on investing the money? And this is called investment time horizon. So looking at how long you'll be able to invest the money before you start to need to withdraw it. And then the next question is regarding withdrawals. And what is the withdrawal time frame? Now, none of us know how long we're going to live, but we need to have a general idea of how long we might anticipate having to make withdrawals. Also, are your investments in qualified or non-qualified assets? And then finally, how will taxes impact your plan? Particularly as you think about retirement, you want to be able to draw from multiple sources of income in a way that allows you to minimize taxes and maximize income. By answering these questions, you'll be able to be more confident in evaluating your investment options and making decisions about them. So what should you invest in? Stocks, bonds, cash? There's really no one answer to how investment should be made, but you want to include a variety of different investment types in your plan. This is called asset allocation. And why is that a good idea? Because there's a lot of wisdom in that old adage, don't put all your eggs in one basket. Every year, there are different types of investments that do well and some that don't do so well. That's because historically, different asset classes respond differently to what's going on in the market and economy. The trouble is you really never know which will be the big winners or the losers ahead of time. So it's important to spread your investments out across different asset classes. Of course, that means that all your investments won't be the best performers every year, but it also means they won't all be the worst performing either. All investments carry some level of risk, but asset allocation is still one of the best tools we have available to help lessen that risk by spreading it out. The strategies behind asset allocation can get pretty complicated. So when you're making investment choices, it's important to work with a financial professional who can help steer you in the right direction. Something else to consider when investing is longevity. Americans are living longer and longer than ever before. Let's pretend that everyone on the webinar this evening is turning 65 today. Men, there's a 50% chance that you'll live past age 88. Women, there's a 50% chance you'll live past age 90. And if you're married, there's a 50% chance that you or your partner will live past age 94. That means that you could be living 30 or more years in retirement. And that's a long time to live off your retirement savings. If you take that into account, the rising costs of medical and healthcare expenses, we've all got a lot of reasons to take our retirement planning seriously. We need to make sure our money lasts as long as we do. So when you think about growing your wealth, be sure to first understand your circumstances, personal goals, and tolerance for risk. Think about asset allocation as part of your strategy, and consider how long you can live into retirement. And finally, just like overall financial plan, remember that your investment plan should be revisited regularly. As your goals and circumstances evolve over time, your investment strategy may be updated too. The third building block in a solid financial plan is wealth preservation and distribution. Here, your goal is to protect and preserve what you've earned and saved. So let's say you've created a good plan, it's gotten you through your working years, and once you've made it to retirement, your goal is to keep what you've worked so hard for during your career. You'll need a different set of strategies to make sure your money lasts through retirement. And if you want to leave a legacy to your family or nonprofits you care about. So let's start with making sure your money lasts through retirement. How do you do that? How can you make sure your money lasts as long as you do? Well, you guessed it, it's your financial plan. So the diagram I just put on the screen is a good illustration of how we help clients in developing a retirement income plan for them. And this starts by developing an understanding of the features and benefits of the most common retirement savings vehicles, such as annuities, investments, IRAs, Roth IRAs. Each of these can be used either as income during your retirement or as a legacy after you're gone. One product that probably doesn't come to mind that's shown here on this chart is permanent life insurance. And you might be asking yourself, well, where does that fit into my retirement income planning? Of course, life insurance, you can use it to help with legacy part of your planning, but also the cash value that's in the permanent life insurance can also be used to supplement your retirement income as well. In fact, this past year with the market volatility, we've been able to help clients who save money in permanent life insurance be able to structure it in a way where they can take money out of their life insurance policies and not have to liquidate some of their investment accounts when their account values are low. So as you get closer to retirement, you'll want to think about the best way to turn these different assets into a stream of income that minimizes taxes and maximizes your income so your money will last as long as you need it. And you'll notice on this diagram these different valves on these buckets. And the valves are just to represent what we call liquidation order. So we help you determine what's the best time to turn these different valves and different buckets on and off to generate the retirement income that you need. You'll also want to start thinking about estate planning. I know estate planning is something that only very rich people need to do, right? Well, not really. Estate planning can benefit a wide range of people. It's not just about who gets your money when you're gone. Think about estate planning as getting the right things to the right people at the right time in the right way. It allows you to maintain control when you're no longer able to make decisions about your money, your health, the welfare of your kids, and at the end of your life. With an estate plan, your wishes will be known and carried out, which can give you and your loved ones a lot of peace of mind. It's never too soon to be thinking about estate planning. In fact, as early as age 18, you should consider establishing a power of attorney for healthcare. In some cases, something happens to you and you can't make those decisions on your own. Having a power of attorney for healthcare is very important. And when you get married, it's important to have a will along with those powers of attorney. When you have kids, you'll want to appoint a guardian in case something happens to you. And remember, if your children ever need a guardian and you haven't officially appointed one, the state will do it for you, and you won't have any say in who they choose. If you want to leave money to your family, your alma mater, or a cause you're passionate about, you'll want to start thinking early about how to incorporate those gifts into your estate plan. You'll also want to think about how to fund your legacy, which is one reason why estate planning and financial planning are so intertwined. For example, if you have permanent life insurance as part of your financial plan to manage risk, the cash value of that policy or the proceeds from that policy can also be used to fund a charitable giving, part of your charitable giving plan. Estate planning not only helps make sure your wishes are honored, it eliminates the friction and tension that can sometimes happen when assets are being distributed. When it comes to maintaining healthy family harmony, your plan is also very important as to what you give to them. Next, giving. Where would you like to make a difference? So when you have time or money to share with causes that you care about and matter to you, what people and purposes will you support? Some of the examples that we've heard from other clients are things like supporting fundraisers, volunteering their time, going on missions trips, starting a scholarship fund, are donating to their church. With your time and money in order, it's easier to support others that have needs, whether you want to help out close to home or reach beyond your immediate circle. If time is what you have to offer, you could take a few hours to volunteer in your community or even take a few days to help abroad. If your passion for giving has bigger price tag, you can think long term, you might want to save over time to establish a scholarship or start your own nonprofit organization. So we've covered a lot of material here, and let me go back a couple pages here, I'm sorry. We've covered a lot of material here, and we've talked about the three aspects of financial planning that creates a solid foundation. And those three, again, are risk management, wealth accumulation, wealth preservation, and distribution. I know it's a lot to think about. And as we continue with our presentation tonight, we're going to have after Bill Dickens presents, we're going to have time for questions and answers. So I really appreciate your time this evening and look forward to our question and answer period.
Peter, thank you so much for that very thorough and wonderful presentation. We really appreciate you lending your expertise and knowledge to our group this evening. Now I'd like to introduce our second speaker, Bill Dickens. Bill works to empower people to navigate life's path and protect what they cherish. As a partner at Moneta, one of the largest independent financial advisory firms in the nation, Bill collaborates with our team on behalf of both family and business clients. Bill applies his 18 years of experience and expertise in helping business owners, executives, and many physicians navigate their pursuit of financial independence. He also maintains an expertise in advising businesses in retirement plan design, as well as counseling nonprofits in creating best practices and investment policy for their foundations. Bill is a graduate of UMSL as well, and also a certified financial planner practitioner. So Bill, I'm going to turn it over to you.
So I wanted to spend a little bit of time highlighting some of the things that we've been talking to our clients about, as well as finishing up this conversation with some thoughts with regard to how one might go about exploring a partnership with a financial advisor professional, and what types of questions, how one might do due diligence to find a partner that fits your needs. So the CARES Act, certainly something that has been in the news a lot, and certainly something that has provided some much needed relief to the economy, as well as some planning opportunities for individuals who may have been impacted or are impacted by COVID-19. One of those planning opportunities relates to retirement plan withdrawals and loan relief from 401k plans or 403bs that anyone may have, be current participants in. So prior CARES Act, just as a way of background, one is unable to access, in most cases, access retirement dollars, whether they be IRA, 401k, 403b, earlier than age 59 and a half without realizing a 10% early withdrawal penalty for doing so. The CARES Act provided some relief for that and some early accessibility for those impacted by COVID-19, allowing for distributions from retirement plans for up to $100,000 from qualified retirement accounts. Those normal 10% penalties are waived so long as, you've been indeed impacted negatively from a financial standpoint by COVID-19. A couple of things to keep in mind if anyone in the meeting here today were to explore this strategy. Of course, the income that is, the income that would be associated with the distribution is still taxable. Now, under this law change for 2019 or 2020, you do have the ability to ratably distribute or allocate that income over a 3-year period of time. So for example, if you were to take $90,000 from your retirement account, you could record that income and of course the taxes associated with that income event over a 3-year period of time, 2020, 2021, and 2022. You do have the opportunity, if you are so desirous of, to recognize all of that income in the year of distribution, which may or may not be relevant for your planning circumstances. With regard to qualified retirement plans, 401ks, 403bs, previously under prior law, the maximum loan that one could take from their 401k was limited to $50,000. Under the CARES Act provisions, one can now access loans to the extent your account values exceed $100,000. One can take a loan of up to $100,000 from their 401k plan. So again, it's the maximum loan of up to $100,000 or that participant's vested balance. It's important to note that not all plans are created equal on this particular topic. Your employer, plan sponsor, must have amended the plan for these coronavirus options. So certainly something to discuss with your HR or accounting department if this is a planning tool that you might pursue. As far as those who qualify, it really breaks down to those who are directly impacted. So if you've been diagnosed with COVID-19, a spouse has been diagnosed with COVID-19, you've experienced adverse financial consequences from being furloughed or quarantined or having reduced work hours, you've had adverse financial circumstances due to the lack of child care, or for that matter, if you operate or run a business or own a business that has been negatively impacted by virtue of restrictions resulting from COVID-19, these are all gateways, so to speak, to accessing retirement dollars early. With regard to verification, there is no verification or any documentation that one needs to provide to the IRA custodian or 401k plan provider. It's up to the taxpayer, should that taxpayer be audited at some point in the future, to be able to illustrate the negative financial impact from COVID-19. Moving to the next slide, additional planning opportunity as it relates to retirement plans is the temporary waiver on required minimum distribution rules. So again, in 2000, or as a way of a little bit of background, in 2018, at the end of 2018, went into law in 2019, a big tax act was put into law, that being the Secure Act, which moved from age 70.5 to age 72, the age at which you have to begin taking distributions from your retirement accounts. This applies to 401k, 403b, IRAs, and the such. Under the CARES Act, there's been a moratorium placed on the requirement of minimum distributions, thereby allowing one, if they're so desirous to do so, to not take a distribution. The result is, of course, lesser taxable income that one would realize on their income tax returns. And the spirit of the legislation is to allow those dollars to continue growing, working in your retirement account, as opposed to, particularly in the February-March timeframe when the markets had drawn down, as opposed to having to lock in those losses or lock in those declines by virtue of the requirement to take a distribution. This moratorium also applies to those who turned age or turned age 72 in 2019 and deferred their first minimum distribution to 2020. Those folks would have to usually take that distribution by April 1 of 2020. If you fall into that camp, you do not have to take that distribution and can defer that one more year to 2021. Those who may have an inherited retirement account, inherited IRA, and such, who would normally also be subject to taking a minimum distribution, this moratorium also applies here, and one can defer that distribution into the year 2021. If you happen to have already taken your minimum distribution and are just hearing about this for the first time, you certainly can return it, although that time or that clock is ticking, so to speak, in terms of when you can return those dollars. If you've taken a minimum distribution and would like to send it back to your retirement account, effectively unwinding it, that needs to be executed by August 31st. Qualified charitable distributions, for those who are charitably inclined or not, none of that is impacted as it relates to this waiver on required minimum distributions. Charitable contribution relief, and part of that, some of that tax act that went into law in 2019 had impacts on in many different areas of the tax return, not the least of which the standard deduction that is applicable when one's completing their tax returns. In the standard deduction effectively for married filing jointly or single effectively doubled in 2019, thereby further limiting the amount of folks who would normally itemize their income tax deductions. I highlight this because an unfortunate victim, so to speak, of some of this tax act was the not-for-profit community. And for those who are charitably inclined and who may have been able to take advantage of tax deductions on their income tax returns for charitable contributions, may otherwise not be able to get any benefit or any additional benefit for charitable contributions with a new higher standard deduction. The CARES Act did place a nod towards the charitable giving community in that cash contributions of up to $300 can be deducted above the line for contributions to Section 501c3 organizations. So this is a nice feature in that regardless of whether or not you itemize, you're able to still deduct up to $300 in cash contributions to charities under the CARES Act in 2020. Again, this was to incentivize continued charitable giving and philanthropy despite some of the economic challenges of today. A probably lesser relevant for most, but for those who charitable planning and charitable giving is a cornerstone of one's financial plan, the Secure Act of 2019 did increase the limit at which cash contributions to charity can be deducted. Typically, your ability to deduct cash contributions to a charity was limited to 50% of your adjusted gross income, which is just the bottom line on your income tax return before itemized deductions. It was limited to 50. The Secure Act took it to the ability to deduct up to 60% of your adjusted gross income, and the CARES Act has ratcheted that up all the way up to 100% for the year 2020. And again, this is for cash contributions to public charities only. Some consideration for those with student loans, student debt relief as part of the CARES Act as well. Major short-term implications for federal student loans, student loan borrowers. Again, I emphasize federal because this is not applicable to private lenders as part of this legislation. So two key features for those who may be employed by an employer who offers some type of student loan assistance in the form of paying down a portion of one's student loans. Typically, that payment or that payment of a student loan debt by an employer would be considered taxable income to the employee. Under the CARES Act for 2020, that up to $5,250 of student loan debt payments made by the employer are excluded from the employee's income. This provision applies for all payments made before January 1 of 2021. So again, a 2020 tax year relief only. For those who aren't so fortunate to have that type of support from an employer, there's also been a moratorium on or a suspension of federal student loan payments, including interest, for 6 months. So that clock is now coming up, or coming to an end at the end of September. So again, here, there is no, our payments are essentially suspended. No interest is accruing during this 6-month period of time. So a great benefit, or a nice feature for those who with student loans or student loan debt. And as an aside, for those who are able to continue making their student loan payments, a great opportunity to do so, as those payments that typically would have included some part principal, some part interest, still continue, or making those payments currently would effectively have that full payment going to principal, thereby paying down that student loan balance more quickly. Well, won't spend too much time here, but certainly many or most in the audience are probably very well aware of the fiscal stimulus to Main Street, so to speak, in the form of direct payments to U.S. taxpayers. Again, this was, this is associated with certain income levels. So if your income levels were below a certain threshold, which is highlighted here on this, you received a stimulus check. There seems to be momentum for an additional round of stimulus forthcoming, although that is currently being debated in Washington. But certainly, make no bones about it, I think that has been indicative of keeping the U.S. consumer to some degree alive during these certainly trying times in the economy. Mortgage forbearance, again, forbearance here being the key word, that this, different from interest not accruing in the student loan circumstances. Forbearance is essentially again, an opportunity where one can effectively take a pause on their mortgage payments, moving those payments to the back end of their amortization schedule. But mortgage forbearance was part of the CARES Act legislation, largely limited to, or in fact exclusively limited to, federal or government-sponsored entities, with offering mortgages, although in my experience and having heard some different client circumstances, I think this many private lenders are also honoring this same opportunity set. So again, the forbearance does not erase what you owe. You'll still have to repay any missed or reduced payments in the future. Keep in mind that your interest is still accruing, again, different from the student loan concept that we were just talking about before. And also keep in mind that even if you choose to elect mortgage forbearance here, taxes, insurance are still going to be due, and so you need to plan accordingly, even if you aren't currently making principal or interest payments. Very much like the legislation associated with early retirement plan distributions, there is no specific documentation that one needs to submit other than to indicate that they have been negatively impacted by COVID-19 and are thereby requesting this forbearance. Other planning opportunities, maybe not necessarily related to the CARES Act. Some of the things that we've been working with clients on this, or so far this year. Tax loss harvesting, certainly as the market drew down in February and March, created the opportunity to do some swaps, so to speak, of investments. Again, not leaving the market, but maybe exchanging one investment for a similar but different type of investment for the exclusive purpose of harvesting a loss. And again, why would one consider doing something like that? Losses, to the extent that you have them, are available to offset capital. Capital losses are available to offset capital gains that you may accrue later in the year. To the extent your losses exceed your capital gains, you're able to deduct $3,000 of those losses against your ordinary income. And the nice thing with capital losses is that those losses can be carried forward indefinitely. So if you don't use them all this year, you can use them in future years. And although the market has rallied nicely, that's been largely much of that rally in the market has been within large company U.S. stocks, more specifically technology-related names. So there may still very well be some opportunities in your non-retirement investment portfolios and small caps and international where losses may still exist, where you could potentially take advantage of this tax loss harvesting concept. Another thing we've been talking with our clients a lot about is recognizing the extraordinary amount of fiscal stimulus that has occurred and a burgeoning debt levels. The concept or the thesis that taxes may be going up in the future certainly doesn't seem that far-fetched. So the extent that clients are in a position that they could potentially accelerate income this year, which incidentally we are currently operating in a historically low taxing environment, accelerating income in a tax year like this with, under the guise that taxes may be going up into the future. Some of those examples might be converting a traditional IRA or pre-tax retirement account to an after-tax Roth IRA. Yes, you have the income tax burden today in that conversion, but if you're able to convert those dollars, moving it into a tax-free vehicle like a Roth IRA at what may be a lower income tax rate than you otherwise may experience in future years, certainly there may be some advantage to doing so. Same for our business owner clients who have maybe some deferred income, accelerating it in a year like this, where taxes again are from a historical standpoint are relatively low. Mortgage refinancing has been another hot topic, again, as the Fed has deployed some extraordinary monetary policy, driving interest rates lower. Earlier this week, we helped some clients lock in 30-year fixed-rate mortgages at 2.6% and a 15-year fixed-rate mortgage at 2.375%, numbers that I've certainly never seen in my career, and certainly rates as low as they've ever been. And then, of course, investment rebalancing. The market has been on some type of roller coaster this year with, considerable and hasty drawdowns in the March and February timeframe, and what has been an extraordinary rally since then. It's important, as Peter was describing before, about the relevance of asset allocation, making sure that your asset allocation is consistent with your long-term goals and objectives, and that your risk budget, so to speak, isn't out of whack as the market experiences this up and down roller coaster. So transitioning to selecting a financial planner, again, when we think about when I talk to potential clients or folks who are interested in exploring a partnership with a professional, certainly there are lots of different approaches to financial planning in the marketplace, lots of different experiences, areas of expertise. And so no different than the due diligence that one would do in any major purchase, taking the time to do your due diligence as you evaluate a partner to help you navigate your life's path is a critical part of this whole process. So these next 10 slides just highlight some questions. These come straight from the Certified Financial Planner Board of Standards. Some questions that certainly would be advisable to inquire with any financial planning professional that you may be considering a relationship with. So first and foremost, qualifications and credentials. There are a number of different credentials in the marketplace, many good ones. The Certified Financial Planner designation is certainly in the industry of financial planning is considered the gold standard in large part by virtue of its strict ethical standards, its requirements to be able to practice with the designation between the mandate of a college degree, the coursework that is the very specific coursework that is required to even be able to sit for the exam to become credentialed, paired with a requirement of several years of work experience before you can ever practice with the designation, and the one's requirement to illustrate their technical expertise via a comprehensive 2-day exam. Other excellent designations to be on the lookout for: Chartered Financial Analyst, which is more geared towards the investing disciplines; Certified Public Accountant for tax expertise; Chartered Financial Consultant; Chartered Life Underwriter, all excellent designations. Another important question is confirming or validating that the advisor who's providing you advice is in fact a fiduciary. Believe it or not, not all financial advisors are a fiduciary, and that fiduciary is really that standard that is and commitment that all the advice that you receive is always rooted and exclusively in your best interest. Asking that question, frankly, having that commitment to a fiduciary standard put in writing are certainly best practices as it relates to seeking out a financial planning professional and a partner in this journey. What experience do they have? What experience do they have counseling clients like you? Ask for specific examples of where they've, where an advisor may have helped a client with similar circumstances as you or similar aspirations. Ask them to see a sample plan and to learn more about how they approach that circumstance, and hopefully arming you with a better perspective on what that relationship might look like. How long have they been in practice? Another key part. If experienced, how long do they intend to keep working? Again, making sure that that timeline matches up with yours. If you are just starting out in your financial planning journey, having somebody that can grow with you probably makes a lot of sense. So again, asking some of those key questions. What services do they offer? Products, services, advice, investment, is it a mostly investment-only relationship, income tax planning, retirement plan administration, estate planning, so on and so forth. Again, making sure that the service offering and areas of expertise coincide with what is important to you and how that aligns with your goals and objectives. What is your approach to financial planning? Ask if the advisor will create a comprehensive financial plan for you. Certainly, as we work with our clients, that is the cornerstone. That is the foundation of each of our client relationships. Again, a financial plan is a document that evolves over time as one's personal circumstances, goals, objectives change. That plan should evolve along with you. But it is, we utilize that as sort of our touchstone, so to speak, in terms of how we counsel our clients, because that plan is rooted exclusively in those things that are, or the realization of those things that are most important to our clients. How will that advisor interact with some of the other professionals on your team, whether it be a CPA, attorney, banker, benefits administrator? These are all relevant to the making sure that the puzzle pieces that make up one's financial picture fit together as neatly and as efficiently and as effectively as possible. Understanding what type of clients the advisor work with. Again, there are various niches that exist in the marketplace, whether someone who is more focused in investments or income taxes, so on and so forth, and even more so specific circumstances. So what is their experience in working with retirees if you're approaching retirement? What is the experience working with corporate executives if you find yourself needing assistance or help thinking through stock option planning and as such? So again, understanding what their areas of expertise are, the clients they serve, as well as their business model. So for some financial advisors, they may have certain asset minimums or profiles of clients that they're working for. And again, this is all part of making sure that we find a mutually beneficial fit. Understanding as you enter into that partnership, who will you be working with? Again, there are some organizations and some firms who have a team approach where you may have multiple advisors who help you, with various areas of expertise, help you navigate your plan. There's also some circumstances where you may have a sole practitioner. Again, as you're asking some of these questions, you want to understand who will you be interacting with on a regular basis, who will be responsible for managing your account. And likewise, as certainly has been evident in these trying times with offices being shut down and remote working being part of the norm, making sure that a business continuity plan is in place in the event of an emergency. Again, you want to be able to make sure that you have access to your advisor and access to the guidance and counsel you need, as well as what is that advisor's backup plan if, God forbid, something happened to them, or if they, when they retire, who will be there to help you continue on life's path, and how do you begin to develop a relationship, a rapport with that person, and trust as well. How will you pay for your services or pay for the services? Again, in our industry, there are a number of different approaches as it relates to fees. Probably the most common set of circumstances are fee as a percentage of the assets under management, commissions for products sold, a combination of fees and commissions. Lesser, but certainly in the marketplace, lesser prevalent, but in the marketplace, some folks work for an annual retainer, as you might think of in a traditional or perhaps in a legal relationship. Fewer, but some work on an hourly rate or perhaps a negotiated fee for a specific project. Certainly, the fees for service is an important part of this due diligence process, and advise anyone who's seeking professional counsel to not only understand what they're paying, but all the different components of costs that come along with a professional advisory relationship. The advisory fees may be straightforward, but what other fees may exist? Underlying investment management fees, annual account fees, commissions. These are all important and certainly well within your right to ask for an all-in fee estimate to be able to really truly understand what the expenses are associated with a professional advisory relationship. Along those lines, making sure to understand any conflicts of interest that may exist. Certainly, there are circumstances where a conflict of interest may exist, and understanding those in advance is an important part to the trust proposition. Some advisors may have selling channels or relationships with mutual funds or insurance products or insurance companies, so on and so forth. So again, it's important as a consumer to understand what those relationships are as you evaluate and take in and the guidance that you're receiving from your advisor. And then finally, this is all available in the public domain, but FINRA, the SEC, and if that advisor is a certified financial planner or practitioner, one can search any one of these websites to identify any potential disciplinary actions or unethical behaviors that may have occurred in that advisor's history. So certainly on any one of those websites, you can search by name of a financial planning professional to ensure that you understand that person's past experiences and or any issues that may have arisen. So Sharon, I'm going to turn it back to you, and appreciate everyone's attention.
Well, Billy, you are a true champ. Thank you so much. You handled that audio difficulty so well, and we're very grateful. That was a fantastic presentation. And I've got some questions coming in, so I'm going to ask Peter, there he is, to join us, and I'm going to throw some questions at you two. The first is from Timothy. He asks, how do we best save for children for a 4-year college fund and retirement at the same time?
That's a tall order without knowing all the details. So with anything in life, you know, I mentioned in my part of the presentation about that topic that if you have the ability to save for both, that's great. Some people don't have the ability to save for both retirement and college savings. It also depends on the age of the kids. 529 plans have probably become the most popular savings vehicles for college savings and even elementary and high school education. And Bill can share a story he shared earlier today about that in his personal experience. But I would say focus on your retirement savings, like I mentioned in my presentation, and then as you're able to save money for college, because the kids will have access to other sources. I remember I have 3 grown adult children now, and I remember planning for their college savings. And, you know, sometimes the numbers are just so large, you wonder how you're ever going to save enough money to pay for college. What we found when our kids went through college is they never paid 100% of the tuition. There was usually other types of scholarships and things like that that they had access to. So I would encourage you to do some planning, obviously, for college savings, and 529 plans are a great tool to do that.
Yeah, I'll just add, Sharon, if I may, you know, as the old adage goes, one bite, you know, how do you eat an elephant one bite at a time? You know, I think as someone with young children, myself, yeah, I think it's a balancing act of maybe perhaps a little bit of both, right? Certainly presumably the college education and tuition bills are likely to arrive sooner than retirement. So beginning some level of savings in the 529, which is an excellent vehicle for saving for college, paired with certainly being sure to take advantage, particularly if you work for an employer who may offer any type of matching contributions or the other, taking advantage of that as well. But you know, the reality is you know, with limited resources, sometimes we just have to you know, take a middling approach, recognizing, as Peter said, there is other avenues that a student may be able to take advantage of, not the least of which student loans as well.
Great, thank you both. So I have another question from James. Should I be preparing for another 30% drop in the market over the next 6 months?
It's certainly possible. We're not anticipating that, you know, based on information we have right now. You know, the key we're always going to have volatility in the market. You know, earlier this year, we did have a 30% drop in a month and a half period of time. That's all been recovered in the markets. The key to long-range investing is having an investment plan, like I mentioned earlier, about structuring an investment plan that includes asset allocation, diversification, looking at your long-term horizon and planning goals, and structuring your portfolio that's consistent with your financial plan. I think that's the real key, not trying to time the market. I've seen too many clients over the years get hurt themselves worse by trying to time the market. But what we do is we do help clients in periods of market volatility to be very defensive in their portfolios and respond to some current market conditions. But good long-term investing, really the key to it is staying invested, having a good financial plan, and making sure you're diversified properly.
Yeah, Sharon, I'll add if I may. You know, James, you should always be prepared for market drawdowns. What I mean by that is, you know, market drawdowns are inevitable. What we don't know is the timing and the extent thereof. So to Peter's point, having an asset, you know, as you conclude upon asset allocation, that balance between risk assets versus more defensively minded assets, making sure that mix is appropriate towards your long-term goals and objectives, recognizing that when you least expect it, the market can and will draw down, and as we saw in February, can draw down very quickly. So again, understanding the risk in the portfolio, making sure that that level of risk is appropriate for both your mental well-being, so to speak, as well as you're consistent with your long-term goals and objectives, I think is the key here. And as Peter said, it's about time in the market as opposed to timing the market. So as you develop that investment policy, that asset allocation, staying true to it. When the market's drawing down, that's the time where we want to be taking profits out of the fixed income part of the portfolio, the safety part of the portfolio, buying stocks when they're cheap, and conversely, as the market rallies, in connection with or in concert with your investment policy or asset allocation, staying true to that asset allocation and systematically taking profits out.
Great. I think that's really, really good advice. Katrina's asking what you all think about HSAs, health savings accounts.
I believe they're an excellent tool. First of all, you have to have, in order to save money in an HSA, you have to have what's called a high deductible healthcare plan. So in fact, if you set an HSA up and you're not a participant in a high deductible plan, you will not be able to contribute to an HSA account. But it's a very good tool for saving on a tax deductible basis and a tax deferred basis, additional money that you can use for a variety of purposes, specifically medical care down the road. So I think it's a very good tool when you participate in a high deductible plan.
Great, thanks, Peter. So Paul wants to know, stocks, stock funds, bonds, or which is best to weather the current financial storm?
Well, yeah, go ahead, Bill.
Well, we have a couple of very different types of assets in that list right there. I mean, certainly an FDIC insured CD is about as safe as an investment as one can acquire in today's world, coming with the full faith and backing of the federal government. The unfortunate reality is in CDs today, you are nearly assured a real loss. And when I say a real loss, when you take whatever return you may be able to squeeze with a CD and relate that back to just the natural implications of inflation, you're likely to have a negative return when we back off the forces of inflation. Now, stocks, as opposed to a stock mutual fund, again, that's stock market risk. An individual stock certainly introduces what we refer to as systematic risk, where which is the risk that something specific happens to that company that could be detrimental to the stock price. A way to hedge that risk is via a more diversified mutual fund or exchange traded fund, where instead of being exposed to the movements and the business risks of an individual stock, you're able to diversify that and spread it out over a basket of stocks, again, whether it be through a mutual fund or an exchange trading fund. But certainly a very different risk profile than an FDIC insured CD or government bond.
For sure.
And also going back to a diversified portfolio, you want some stocks, you want some bonds, you want some cash. And depending on what your time horizon is for that money, you want a different percentage in each of those different buckets.
Absolutely. Okay, I'm going to try and squeeze a few more questions in here, folks. We appreciate them. The next one's from Angela. What's your opinion on obtaining whole life insurance? Also, what are annuities as a form of retirement?
Okay, I'll take that one. What was the question about the whole life insurance?
What is your opinion on obtaining whole life insurance?
Okay. Well, again, I always bring clients back to what is their plan, what is their goals and vision for the future, and whether it's life insurance or investments or annuities, whatever. To me, those are just tools that help clients implement a plan. So, whole life insurance can play an important role in someone's life. I've been doing financial planning now for over almost 21 years now. And I've seen how clients have used whole life insurance throughout their lifetime. It's just not at death, but it's also during their lifetime. And like I mentioned earlier, being able to access the cash values during their lifetime. So it can play an important role for helping you with income needs while you're alive, and then also helping you with legacy needs, whether you want to leave a certain amount of money to your kids or grandkids or to charities you care about. Annuities can also play an important role from the standpoint of longevity. I mentioned that in my presentation, that one of the biggest risks in retirement is longevity risks. So the role of annuities play an important role in providing a certain level of guaranteed income, no matter how long you live. So again, it really goes back to your plan. What are your goals and objectives? And then determining what are the right vehicles and combination of vehicles, like that chart I showed earlier, showing where you should put your money in these different buckets to generate retirement income for yourself.
That's right. And so everybody knows this is being recorded. It will go back and view it on the UMSL website, but we're also going to send out the slides that Peter and Bill shared for your reference. And for the questions we don't get to this evening, because we just have another minute here, we'll respond to those via email to you. So here's a question. How long do you think mortgage rates will stay low? That's from Katrina. I thought that was a good one.
I'll take that one, Peter. You know, certainly the low mortgage rates are a byproduct of the interest rate environment as a whole. And the Fed has effectively today manipulating interest rates through monetary policy with the goal to drive rates down. And certainly Chairman Powell has given no indication of pulling back on that whatsoever. It's interesting, as rates started to come down in the markets across the board, when I say rates, I'm talking more or less to bond rates, as rates started coming down across the market, it was an interesting phenomena to see that mortgage rates were not coming down at a commensurate level. That was a byproduct of the sheer demand that was occurring in refinancing, and the fact that banks just didn't have to bring down rates because there was enough demand, or there was more demand than they could even keep up with. As that initial surge of refinancing has slowed a little bit, rates have started to, as I indicated before, have come down. But I think as long as the Fed continues to deploy all of its, nearly all of its tools in its tool chest to keep rates low, I think it's probably likely that we will see rates floating around here, at least for the foreseeable future, or for the near term.
Great. Well, I just want to thank Bill and Peter once again for their thorough and detailed presentations and for volunteering their time this evening. And also they were up bright and early with me this morning at 8 a.m. So thank you both so very much. Thank you, everybody. You'll receive a follow-up email with a survey and the slides. And we thank you for participating and wish you a wonderful evening.